Hi. Today I'm going to talk about the quantitative mutual funds. There are many mutual funds that have come up in the last few years in India, but elsewhere as well. They're using quantitative models for investment purpose, right? And a lot of them actually are doing very well. I know a couple of quant mutual funds which are based out of India, and they're doing amazingly well. But it is unclear as to whether they're able to outperform the other other mutual funds, purely because of the algorithms they're using, or is there totally a different reason for that, right? So I'm going to give my view. It's important to understand how you assess performance of a mutual fund, right? The new age investor, they're making a mistake by assessing the mutual fund performance, or for that matter performance of any financial asset, just by looking in the performance over the 1 year or 2 year time. That's actually not very good way of assessing performance of a mutual fund, or for that matter any traded asset. You really need to take a longer horizon. I personally believe that you need to see at least the performance over at least 5 to 6 years. I think even a 10-year period is a good one. Right, otherwise you probably do not know what has happened to some of these funds in the past. There was a fund called LTCM, hedge fund. It did stupendously well. It was a quant fund, by the way, started by Nobel Prize winning economist, very highly qualified people. They were using quantitative algorithms for trading, and they did really well for the first 5 to 6 years, until in 1998 they lost so much money they really had to be bailed out by the US government. So that was their story, right? So a given fund might do really well for some time, or maybe for a couple of years, and then they may really do terribly bad for 1 year, and whatever profits they have made over the last 4-5 years, they would all lose that in that particular year, right? So people only focus on the return but not focus on the risk they're taking, right? And you will never know what sort of a risk they're taking until and unless you do actually proper research on the portfolio, which is, by the way, publicly available. You could do an assessment on that, and without doing a proper research on that, you cannot simply compare two funds and say that look, this fund uses some algorithm, hence it is outperforming. It's hard to say that. There may be some evidence to prove that, but without doing a proper research, it's not easy. I was reading some articles on Economics Times, but also on Live Mint, two very reputed business journal in India. The way they have done the analysis is purely based on simple averages, right? Just take the average CAGR over the last couple of years and compare that with other funds and the benchmark index, and you see that some of the quant funds are doing better than the peers, and hence investing in quantitative funds is therefore advisable, right? That plain stupid, in my view. That's not how you do an assessment, right? You really need to first of all compare apple to apple, right? You do not know actually the risk that a given fund has taken, right? You need to give them some time, right? A lot of the quant funds are quite new, so it's better not to even compare their performance, right? You really need to be careful also while investing in them, because they might do some of the things just to impress you for the first few years, but you never know what sort of risk they are taking. That's easy to assess actually, but you need to spend time in doing that, rather than simply believing in these reports from even though these reports may be coming from reputed publications, right? All right. So it's not easy to say that the performance is just because of the models. There maybe other reasons, purely other reasons, right? So give them some time. Having said that, a lot of things have changed in the last maybe about 5 years, but also I would say 10 years, ever since people have been using internet to invest. People might we can argue that maybe this has changed post COVID, but even pre COVID, right? Ever since you could simply use some apps to buy shares, sell shares, things have a lot of things have changed in the market. A lot of retail investing was more of a thing, used by upper middle class rich people. That has changed in almost all countries in the world now. Even people with less money, middle class people are now investing in the market. A lot of people are not well educated in personal finance. They have no understanding of shares, they have no understanding of basic finance, basic personal finance. So there may be some patterns in the investing pattern you could exploit and make money if you can do that smartly. So there may be some new patterns that may be emerging because of these new investors putting in a lot of money in different asset classes. So that because of that, maybe some of these quant mutual funds are a bit more successful because they have because other investors, what they do is that the more other mutual funds, they only assess the companies. The investment is purely based on the value, right? Value of the stock, right? They do the valuations, the standard theory using the standard finance theories. But there are other things also, right? You also have liquidity, the insights on liquidity, but also insights on the sentiment. Most of them do not use that. Actually, the ones actually who are playing with the data know actually where the liquidity is at the moment, at a given time, and what is the sentiment, right, about a given sector or given stock. And based on that, they can they do the asset allocation. Probably a lot of the other mutual funds which are more value based and not doing that. But so far I know, I think, just regardless of what kind of mutual fund you are investing in, most of them are now doing some data analysis, right? So if the quant funds are doing some sophisticated data analysis, I am not sure about that. Are they using sophisticated algorithms? I am not sure about that. A lot of the fund managers who are managing quant funds, they don't have long experience in quantitative fund management. At least I came across some of them. So I'm not sure whether they are even familiar with some of the quantitative investment theories or not. They may be using some basic mathematical modeling, but I'm not sure. Or are they employing people who are good in these areas? I'm not sure about that either. Maybe there's just the name is quant, but they may not be using any sophisticated algorithm. They'll simply be using some data insight, some charts. I'm not sure about that. Okay. But especially in the mature market, a lot of things are happening. A lot of people work in these funds, and there's a longer history also, especially in Europe. I've seen people have been using this for decades. So you have a lot of data to sort of verify that whether you make more money if you invest in these quant funds. But that's not true in India because there's not a lot of data so you need to wait. That's the point here. So my advice, well, I'm not going to give any advice, but I stick to the first principle of investing. So I don't really get impressed with these articles by Economics Times or Live Mint or any of these publications showcasing that why a given fund is doing better than the others because they're using some ML AI sort of algorithms. I don't really buy that argument. So stick to the first principle of investing, diversification, making sure that you understand your risk appetite, making sure that you have a balance between risk and return. All that is super important. So never believe. So the conclusion of this video is that never believe that because you have some highly qualified people working in a given fund, they can easily make 30% annual return over the many years, and therefore you will be able to beat the market every single year, and you can make hell lot of money. That's pure nonsense. I think very not many people have been able to do that, except for a few quant funds in the world. Not many people, none quant funds have been able to do that, right? Having said that, completely ignoring them is not fine. If you think that okay, they're making good money, I think it's good to put some money over there. But again, following the basic first principles of investing is super important, and not to get too impressed by looking at the numbers for the last few years. So that's something I wanted to share. As usual, thanks for watching, and for any questions you can always ask me in the comment section. Thanks.